Hey traders, Clifford back with another video on now how to trade the index. Sunday market open. Let's get into it. All right. Been a while since I made a video. Been working on some things, doing some research on the market that I've decided to focus all of my trading on for the future, and that is none other than the three main stock market indexes: the S&P 500, the Nasdaq 100, and the Russell 2000. I've chosen those three for my main focus for all my trading pretty much permanently for the future. Me coming from a Forex background, it was interesting how I made this decision, but I believe it is going to be the best decision I made for the future, and I'll explain why here in a moment. If you are a forex trader and you've never traded the indexes, you might want to look into it because they're a really good product to trade, and I found now a lot of consistency doing it. And we're going to go over a strategy that has been working for me pretty good. Wanted to share with the rest of you guys, see if it'll help you as well. All right. So first, the index, right? Um, why should you trade the index? I mean, there's many reasons, many different opinions out there. I just believe they trend better, and I'm a trend follower, and I use technical analysis, and that's how I plan my trades. I really don't use indicators much at all, actually. I don't trade with any indicators anymore. I used to in the past, but I found that for me, I have no use for indicators. I just use price action. Price action is the best indicator of all, in my opinion. Support and resistance are the king and queen of the market, and that's all I really need. But if you're using indicators, that's fine as well. So let's get into the strategy. Basically, I trade this one here, the ES, the NQ, and the RTY. Now they also have the micro contracts, which I trade those as well. But the big ones, sometimes I'll buy options on. If you're new to options, I'll make another video in the future about that. But let's just say you use the micro. I use the micro futures. Now, I guess you could trade the indexes many different ways. They got, I think, those ETFs, the SPY, and I think it's called the QQQ or something like that. I've never traded those, but I guess some index traders might look at those too. So you could definitely do that if you're ETF traders and all that. But I like the futures because of the liquidity and because of the volatility. That's where I believe the money is made. So again, I'm just going to focus this video on those three: the ES, the NQ, and the RTY. If you're new to futures, check out one of my other videos and I'll go over the different contract sizes in another video. They got the main contract size, they got the mini micro contract size, and then they got options where you don't have to have the margin to put up because you buy the option basically. All right, so enough of that. So the strategy is this. Basically what I do is I just want to know the the average daily range of the market. This is the only time you will ever see me probably use an indicator, and I don't use the indicator at all for the market. I just want to know the average range, meaning how much does this market move per day? That's all I got to know. So for that, I do use an indicator. Don't laugh. It's called the average true range. So basically, if I pull it up, here's the average true range. If you're new to what this is, basically it's telling you how many points the market moves per day. So this is the ES contract, right? The S&P 500. Sorry, E-mini S&P 500. So here you go, 48 points a day. That's all I got to see. Let's go to the NQ. 250 points a day. Let's go to the RTY. 34 points a day. That's it. I don't use indicators. That's all. The only reason I want to know that is because this strategy involves a daily price move observation. So what you're looking for is, let's go to the ES. What you're looking for is a day that outperforms the average daily move. So what do I mean by that? You're looking for a day that is significant, that, gets your attention. So where's a day like that? Well, if we know the average daily move, this is the daily chart, by the way. Each candle represents one day of trading. And so this is one day. You see this candle right here? Let's just pick one. Here's one. Boom. See that candle? If I measure it from the top to the bottom, I will see this daily range was 88 points. That gets my attention. Why? Because it's more than 48 points a day. So the strategy is this. You look for a big day like this. Here's an 88 point day. And then what I do is I believe in technical analysis. I believe in the Fibonacci retracements. So what I'll do is I'll take my Fibonacci tool right here, put it on that candle. Okay, put it on the candle. Look for the 50% retracement. So this tool takes the high. In this case, the high is 48.04. The low for the day, 47.14. The middle point, 47.59. That's the X. X marks the spot right there, 47.59. What you want to do is place an order to buy at 47.59. And that's it. You just wait like a cat. 47.59 is around, where is it at? Let's put a marker there. Oh, wait, I got the crossbar. Sorry. Okay, 47. There you go. 47.59, right? So here's the day. Again, this is January I'm looking. I just pulled this one out of the blue. So there you go. There's the January candle, right? 47.59. What happened? You put your order, you put an entry order, a limit to buy, right? Nothing happened. The next day, nothing happened. I know it's kind of boring. The next day, nothing happens. The next day, nothing happens. The next day, nothing happens. Nothing happens. Nothing happens. But then, 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5. Yeah, 6. The 6th day later, boom, you were filled. And not only were you filled, but you were filled at a great price. Now, for risk management, what I would do is if you got filled here, go to that same candle, the candle that, broke our observation basically, and put a stop loss underneath the low of that candle. Why do I say underneath there? Because the odds of you getting stopped out are very low at this point. The market has rejected the 50% level of that candle. So in my opinion, for you to get stopped out down here, it's possible. I'm not going to say it's not. Use risk management. Markets are unpredictable. No one has a crystal ball. We're just making educated guesses based on probabilities. So can you get stopped out? Absolutely. But the probability is that you probably won't. So use risk management, put your stop over there, and then boom, you got in at the perfect price. You take your profits, whatever profit taking strategy you use. Let's look at another one. Let's go to the Nasdaq. Let me pick a candle. We'll pick a recent one. Here we go. Now, remember, the Nasdaq daily move, 250 points a day. Is this significant? Yes, it is, because it moved 400. Basically, what this strategy does is it's based on a pullback of a large move that the investors might take profits on that large move before they get back in the market. So that's what you're doing. You're just waiting for the pullback. So here's a 387 point move. How does the strategy work? Same way. Grab the candle, put the Fibonacci retracement on it. Look for the 50% point right there. What is this? 18,126. You can shut off your Fibonacci. So you place your order on February 22nd. Nothing happened the first day. Nothing happened the second day. Nothing happened the third day. Boom, you were filled the fourth day. And again, put your stop loss where? Right behind the low of that candle. Boom, take your profits, whatever profit taking strategy you use. We'll do profit taking in another video. But and that's it. Let's look at one more. The Russell 2000. Pick a day, pick a day, pick a day, pick a day. I don't know. I mean, I would pick this one because it was recent. Like I'll be buying this one right here. See this big candle? If I know the Russell only moves 40 points on average, 35 points a day, look at this day. 60 freaking points. I mean, the odds are that it's probably going to retrace 50%. So I'll put an order right here and then wait to see what happens. Put the stop loss right below here. And then, hopefully it tests these highs and you make a profit. Um, but we can't look at that one yet because it's still in the works. But that's basically it. You're looking for a significant day. Here's another one. What is this? Well, that's 36 points. But I mean that's basically what it is. It's a pullback strategy, and it's buying along with the trend. Um, and it really does work good. Okay, here's another one. S&P. Let's see. Now sometimes you won't get in. Like here's a big day, but look, the market never came back. Okay, so what? You wait for the next one, which is right here. Or sorry, where's the next one? I think that might have been a bigger day. Yeah, so that looks like a bigger day there. So again, 50%. And as you see, most of the time the market makes it. Here's another one. Boom. See that big day? Buy on the pullback. Put your stop right there. And as you see, you never get stopped out. Another thing you could do, I won't talk too much about this in this video because I wanted to make it just about the strategy. But if you're an options trader, you could do this. Like, you see this candle here, you buy on the 50% level. Instead of buying the futures here, buy a call, buy a near the money call right here at the top of this candle. I mean, we'll talk more about options in another video, but that's basically it. That's the strategy, and it's really been working good so far. I mean, it's a trending strategy, so you got to use risk management. I mean, you could get stopped out. Sometimes you will get stopped out actually, unless you're using options. But for the most part, it's very consistent. And not only that, you could actually build a bigger position in a trending market with this strategy. Because let's say you did buy here, and then you see this second candle form, you could enter a second position right here. And using the same risk, just move the stop below this candle from here to here, and then a third position over here, or sorry, a third. Well, okay, that one didn't make it, but then somewhere around here, okay, over here maybe you would enter a third position, and you're building these positions in a trending market. Now, I mean, it, yeah, it really is that simple. So that's what I'm focusing on now. And of course, I mean, if you use indicators, I guess you could use them. Um, I don't think you really need them, in my opinion, because this is the nice thing about this strategy is you're not trading the 1 minute chart, which has a bunch of noise. Now, I mean, if this is your thing, I mean, and you're successful at it, then awesome. I'm happy that you're one of the 10% that didn't fail doing that. But I don't want to trade the noise. I want to trade the real trend. I want to see where the market opened and where the market closed, because that's where the buying and selling pressure is. That's where the institutions are pushing the market. So that's what you really want to be aware of, and you don't need indicators to see that. You just need to look at the daily candle. And the nice thing about this is you could trade this when the market's closed. Like you see this close right here, the market closed at whatever 4 o'clock, 6 o'clock, it reopens. You just put your order. It doesn't matter if the order sits there for 4 days. The bottom line is you're not watching the market all the time. Your eyes aren't glued to the screen, and emotions aren't jumping around all the time. I mean, but again, if you're day trading, and you're good at that, then that's awesome. But for me, day trading never works. So I like this strategy, end of day trading. I make my decisions when the market is closed, and that's the easiest way to trade, in my opinion. So that's about it for this video. If you like the video, feel free to like, subscribe, put your comments below. Look forward to seeing everyone in the next one. And as always, my friends, trade what you see on the charts. Trade well.